So let's start with a quick recap of, or let's go through what we have to cover. So in our last session, those that missed the last session, I do have the recordings as well. I've sent them in the group. In case you missed them, please do let me know. I'll send you again. So we did have our introductory session last week for financial accounting 1. So for financial accounting 1, you are supposed to cover up to, I think it's about chapter 7. So for financial accounting 1, we need to know what exactly are we required to know. So we're supposed to know about the regulatory bodies, the conceptual framework. We're supposed to know the different forms of business enterprises. We're supposed to know about the double entry system. We're supposed to know about the cash book and the petty cash. You're supposed to know about the books of original entry. You're supposed to know about reconciliation. We are also supposed to know about the income statement and the statement of financial position. So those are the areas we are supposed to cover. Now, let's have a quick run through of what we did in the last session. That is for the sake of those that missed the last session. So in our last session, we did look at, introduce the subject, and we said that financial accounting is all about telling the performance of the business. So it's telling us how the business has performed. So how the business has performed, we need to know how the business has performed. So we need to know how the business has performed so that the users of accounting information can get to make decisions out of it. So tine vanhu vanoshandisa the information we've prepared, the shareholders, those that invest the money in the company, they need to know how the company has performed. We have the directors of the company, we have the employees, we have the government, we have the creditors, we have the bank. All these are regarded as users of accounting information. They use the information we have recorded to make various decisions regarding the business. So they are the users of accounting information. They get to use the information we have recorded for making decisions that can either improve the company or they can make decisions as to whether should we give the company loans. So Isusu, as financial accountants, we record the information so that these users can get to use the information. So when we are recording the information, there are characteristics of good information. So the information must have the following characteristics. We said it must be relevant, it must be faithfully represented, it must be verifiable, it must be understandable, it must be timely, it must be comparable. So all these are the requirements of good information. So if we are saying information is good according to the conceptual framework, then it must have these characteristics. Then let's move on. Then we have the IFRS Foundation. IFRS Foundation is one of the branches or the boards that sets the rules that we follow in recording transactions. So we have the IFRS Foundation, which has different branches. So the branches of the IFRS Foundation, we have the IASB. We did talk about it in the last session. IASB, a branch, accounts, which we call the International Accounting Standards. So IASB is the International Accounting Standard Board. So they are responsible for designing the international accounting standards, which the different companies are going to use when they are reporting their financial statements. So we also did talk about the accounting concepts. When you are recording transactions, we are supposed to be guided by these accounting concepts: the prudence concept, the matching concept, the accruals concept, the going concern concept, the historical cost concept. So we discussed these in the last session. Now, let's get moving. Now we are introducing chapter 2. So the second chapter is saying we need to know about the business entities. So the business entities. So for the business entities, we can run a business as a sole trader. We can run the business as a sole trader. We can run the business as a partnership. We can run the business as a company. So all these, they can prepare financial accounting information. So a sole trader, I don't want to prepare my books of accounts. A partnership can prepare books of accounts. A company can prepare books of accounts. So let's start with a sole trader. Let's start with a sole trader. So a sole trader, what kind of a business do we classify as a sole trader business? So the business that we classify as a sole trader business, this is a business where one person is in control. So the business, the entire business is being controlled by one person. So this is an entity where one person is in control over the business. Sole trader business doesn't necessarily mean there is only one person running the business. One person is the one in control. So you can have 5 tax shops, but in each tax shop, you have one employee that you're controlling. As long as all of them, they can't make decisions without consulting you, then it's a sole trader because one person controls the entity. So we can run the business, you always take some shop, but as long as you can't make a decision without consulting me, then it takes the nature of a sole trader. Sole trader, one person controls the business. All the decisions come from one person. This is suitable for small entities like tax shops, the roadside traders, Msika. Those are typical examples of my sole traders. So a sole trader business, they can keep records or they can prepare my financial statements like any other business. But let's look at what benefits does this business have? So if you're running the business as a sole trader, what advantages does this business bring you? So the first advantage of a sole trader, if you're running the business as a sole trader, the business is likely going to, you're going to see that there are benefits to the customers and there are benefits to the owner who have started the business. So we just put these benefits are mixed up, but the benefits to start with, if the business is run by one person, it means they can make quick decisions. Due to no consultation. We don't need to consult others, so decisions can be made quickly. So quick decision making as a result of no need for consultation. Besides making quick decisions, another advantage of a sole trader is that a sole trader business, you realize the owner enjoys all profits. Another benefit of running a sole trader, you realize that there's less legal formalities. You don't need a lot of paperwork to start a sole trader business. You can just get an operating license from the council. You just need a license from the council, then that's it. But if you are running businesses like companies, there are a lot of paperwork that are needed. So for a sole trader, Panama, there's less legal formalities or less paperwork. then the business is flexible to changes in the market. There are quite a lot of advantages for this business. It's flexible to the changes in the market. So zvikanzi now maybe the demand is shifted. A sole trader can easily shift in line with the demand. So they can easily shift as demand changes. Then also a sole trader business. Besides that, a sole trader business, to the customers, they can offer informal credit. To well-known customers, we can talk about offering informal credit. We can talk about also being conveniently located. Located near customers. They operate long hours. So there are quite a lot of advantages. So all these are some of the benefits of this business we call a sole trader. So a sole trader also has disadvantages. Disadvantages of a sole trader. So what are the drawbacks or disadvantages associated with this type of a business? So the disadvantages of the business called a sole trader. Number one, if we are running this business, which we call a sole trader, the first disadvantage we can face is the owner can run the risk of making wrong decisions because arbiter all the decisions alone. So no one is always correct. So you might also at some point you need others to help you. You need others to also contribute in the decision making. So if you make all the decisions alone, there's a high risk of ending up making a wrong decision. So we can say there is a high risk of wrong decision making. High risk of wrong decision making. We have also another problem where you don't share losses. The owner suffers all the losses alone, or losses are not shared. We also have the other disadvantage of if you are running the business as a sole trader, it means that if you're running a business as a sole trader, it lacks continuity. If the owner dies, the business collapses. So the business does not exist forever. Unlike a company, if the owner dies, the company can continue. But a sole trader, it lacks that continuity. Answer that. Hello? Hello? Let's move on. So lacks continuity. Lacks continuity. Besides lacking continuity, the other disadvantage is that a sole trader has unlimited liability. A sole trader has unlimited liability. What do we mean by unlimited liability? In the event that the owner dies, a sole not dies, sorry, in the event that the owner if they are to be involved in debt, we cannot separate the debts of the company and the debt of the personal debt. So zvekumba zvinoaffecta zvekubasa, zvekubasa zvinoaffecta zvekumba. So if you are owing someone pane zvinhu zvekumba, they can end up interfering in your business. And also the same can happen if you owe someone at work, they can come and take your personal property. But for a company, we can't do that. If you have a problem with Strive Masiyiwa, you deal with Strive Masiyiwa, not Econet. The same goes with Econet. If You have a problem with Econet. You deal with Econet, not with Strive.co. There is a gap between the owner and the company. Kanawagma companies, we say there is separate legal, a company is a separate legal entity. We say a company is a separate legal entity. Sorry. Hello, right, should I say? Now on symptom. I think mtano ndiyatozopinda Monday because this weekend andisipinda mtown because pane zviri kuitika. It's okay. Uchiri panenge napo. Okay, let's proceed. So the disadvantages. We've said there is a high risk of wrong decision making. Losses are not shared. It lacks continuity. Then there's unlimited liability. So these are the problems that we can face. These are the problems that we can face if we start a business as a sole trader. Then let's continue. Besides a sole trader, we can start a business as a company. We can start a business as a company. So a company now, or before we get to a company, we can start with partnership. Before we get to a company, let's talk about a partnership. So what kind of a business is a partnership? So a partnership now is a business formed by 2 to 20 people with the sole aim of making a profit. So it is a business formed by 2 to 20 people with the aim of making a profit. So if it's a partnership, it's 2 to 20 people that are coming together to start the business. So for a partnership, we have 2 to 20 people coming together to start the business. Then, if it's a partnership, there are benefits we tend to enjoy. Some of the disadvantages of a sole trader, we tend to overcome them. So what are the benefits of not running the business alone, but running the business as a partnership? So if we run the business as a partnership, the first advantage is more capital tends to be introduced because it's no longer one person bringing the money, but we're now contributing. So more capital is introduced in the business. So more capital is introduced. Besides the capital being introduced, the other advantage of starting the business as a sole trader, so as a partnership, is that the risk of wrong decision making is reduced. Risk of wrong decision making is reduced due to consultation. So now there is low risk. It doesn't mean the risk is not there. It's still there, but it's now lower because now we can help each other in decision making. So the risk of wrong decision making is reduced. The risk of wrong decision making is reduced. Then let's move on. Besides the risk of wrong decision making being reduced, another advantage of operating as partnerships is that if we are operating as partners, it can enable specialization. It can enable specialization. Specialization is where one is now able to concentrate on the area that they are able to do best, the area that they are qualified at. So if you are running the business alone, you can't be a specialist in such kind of an environment. But if we are now operating to the 2 to the 5, we can now specialize. Then also a partnership. We tend to share losses. If we are running the business as a partnership, losses and responsibilities are shared. Losses and responsibilities are shared. Then, what are the challenges that can come with this type of business? So, if we are running this type of a business, the disadvantages are that the first disadvantage is similar to a sole trader, that this business has unlimited liability. So, partnerships still, they have unlimited liability. So the partnership still, they have unlimited liability. Their assets of the partnership are not separate from their personal property. They can lose their personal property as a result of the partnership, or a partner can have their personal problems which can end up interfering in the partnership. It means there is no separation between the business and the owner. So that's, again, unlimited liability. Then we have also the issue of slow decision making due to consultation. So the need to consult others can lead to slow decision making. So it can delay the decision making process. Then also another disadvantage of this business of a partnership, it means it lacks flexibility, because now it lacks flexibility. You can't easily just wake up and change things. You need to agree with others. So lacks flexibility in terms of making changes. So these are some among a number of disadvantages of a partnership. When we start the business as a partnership, we need to write what we call a partnership agreement. So when we start the business as a partnership, there is need to draft partnership agreement. So there is need to draft a partnership agreement. What is a partnership agreement? It's a document. A partnership agreement is a document. It will tell us the terms and conditions of the partnership. So we are entering into the partnership under what terms and conditions? So the partnership agreement can tell us how we are going to share profits. So it will tell us the share of profits and losses. The agreement will further tell us, so besides how we are supposed to share the profits and losses, the agreement should further talk about the capital to be introduced by each partner. The capital to be introduced by each partner. So the agreement can also tell us if there are any interests. If you are to borrow money from the partnership that's draws, do you pay interest? So any interest on capital and drawings. So any interest on capital and drawings. So the agreement should highlight if there are any interest on capital or interest on drawings. Then also the duties and responsibilities of each part. Hello, is that a question? Okay, kindly keep your mics off so that we won't hear your background noise. So let's proceed. So these are some of the things we agree in the partnership agreement. How we're going to share the profits, how we're going to share the losses. Are there any partners that needs to be given salaries? So all that is agreed in the partnership agreement. Then, besides the partnership, we can also start a business as a company. So all these businesses, they prepare financial statements. They come up with the income statement. They come up with the statement of financial position. Now, a company is now a business which is formed by shareholders. So it is a business formed by shareholders. Company is a business formed by shareholders. So a company can have a lot of people. It's not restricted. So it is a business that is formed by shareholders. Then we can look at two companies. So the company can be a public limited. Public limited or private limited company. So the company can be a public limited company or it can be a private limited company. It can be a public limited or private limited company. So let's start with the public limited company. So the public limited company, these are companies that can sell their shares on the stock exchange. So these are companies that can sell their shares on the stock exchange. So if you want shares today, you don't go into the shop and say, I'm here to buy shares. We can go to the stock market where they buy and sell shares. So the public limited companies, these are companies that are responsible, that can, sell their shares via the stock market. If it's public, it means anyone can buy the shares. Anyone interested, they can buy the shares. So the shares are not restricted as to who can buy them. The shares are available to all members of the public. So the shares are available to all members of the public. But we have another type of company called a private limited company. A private limited company, if it's a private limited company, it means if it's a private limited company, it means the shares cannot be sold publicly. So private limited companies, if you want shares for these companies, the owner has to approach you. They invite you to buy the shares secretly. So the shares of a public limited company, the shares are sold privately by invitation. The shares are sold privately by invitation. So for you to buy the shares of a private limited company, you have to be first of all invited. You have to be first of all invited. So invited by the company itself. Sometimes what you can do is, if kana gatanga company yako and you want finance, you can approach those vanimari and you give them an offer. Can you give me Maria Card and I'm going to give you shares in return? So a private limited company can do that. You give shares in return. You get money, but the shares are not available on the stock market. That's the main difference. imwe inotengesa mashares to everyone who is interested on the stock market. Imwe inotengesa mashares privately by invitation. So what are the advantages associated with running companies? Advantages of companies.
May I ask?
Yes.
Public limited company, because these companies these are companies that can sell their shares on the stock exchange.
Yes.
Stock exchange, ichi.
Stock exchange, no, that's a good question. Stock exchange, ndo kunotengwa nekutengeswa mashares. Tinenonzi Zimbabwe Stock Exchange, if you have ever heard of that. Ndo kunoita zvokutengwa nekutengeswa mashares ema-public limited companies akaita sana Old Mutual. We have mashares ana Old Mutual, mashares ana Insco, those public limited companies. Kana uchida kutenga mashares iwayo unotonotarisa pa-stock market. So inonzi stock exchange is ingori market inotengwa nekutengeswa mashares. Tinenonzi the Zimbabwe Stock Exchange. It's a market where we buy and sell my shares.
All right, thank you.
Okay. So advantages of the business being run as a company. So kana tichirana business riri a company. Tichirana business riri a company, one of the first advantages is the capital. Because you can have, a company can have up to even 50,000 shareholders. So more capital is introduced. So we tend to have a lot of capital because vanhu vanogona kurana that vanogona kuisa mari yavo vanenge vakawanda. So more capital can tend to be introduced in the business. Then also, if you're running the business as a company, there is also the other advantage of if you're running the business as a company, the other advantage you can talk about is there is continuity. If the owner dies, or can just say the business has continuity. So if Strive Masiyiwa is to die, Econet doesn't close. The founders, even if some of the founders, if Bill Gates, if they are to die, it doesn't mean Microsoft is going to close. So we are looking at a company, then it means there is continuity. There is continuity. So the business continues even in the absence of the originator. Then besides continuity, also it's a separate legal entity. So it has limited liability. It's a separate legal entity. So it has limited. We're saying for a sole trader and a partnership, they have unlimited, but this one, it has a limited liability. So if you have a problem, you face the company, not the owners. And if you have a problem with the owners of the company, it doesn't affect the company. So a business, that company is a separate legal entity. Then also it can hire skilled manager. You can say it can hire skilled personnel. If you're running as a company, you can actually access qualified people. We can't say Pamsika to 5 O-levels and a degree, but for a company, we can hire people that are skilled. So which ends up giving us a better advantage of success because we are running the business with people that are skilled. Then we have the disadvantages. The disadvantages of running the business as a company. So if you're running the business as a company, more training is needed. I'm sure the reason why we are all learning this is so that you can be able to run a company. So it requires someone who is trained, someone who is skilled. So you can't just run a company nekuti wangonzwa mumwe achiti no, in Indrugita business, then you easily copy it. You need to have the skills. The company also, there's slow decision making due to consultation. It is also not flexible to changes in the market. The company can't easily switch kuti chitengesa grocery tatwa kuhembe. Not flexible to market changes. Not flexible to market changes. So these are some among the disadvantages of companies. So going back to what we have to cover, let's check the module, what the module talked about. So we have talked about the sole proprietor, that's the sole trader, advantages and disadvantages. We have talked about unlimited liability. We have talked about lack of continuity. Partnership, we have talked about the advantages of the partnership, the disadvantages. We have talked about what the agreement talks about. So we'll talk about the close cooperation. Then the limited companies. So we've talked about the companies and their disadvantages and advantages. So I think what we left out is the close corporations. But for close corporations, these can be called PBCs, the private business corporations. So for close corporations, they have the nature of a sole trader and a nature of a company. So it is a less complex company. So this one is a less complex what? Company. A PBC or a closed corporation. It comprises of one or more people. However, there is no distinction between the owners and the management. So this type of a business, which characteristics does it have? So closed corporations, they cannot sell shares akawanda. It will be a business rakada sole trader rekuti harina vanhu vakawanda, but they register it as a closed corporation, so it can sell shares. It can sell shares, but the shares will be limited. So the members with the shares, we call them, those who have bought the shares, we call them members of the closed corporation. So the closed corporation is only liable to what they've invested in the company. Closed corporation. It combines the characteristics of a sole trader and company, in that it can start with one person. It can start with one person, and also it can sell shares, but these are limited. So it can sell shares, but these are limited. So if we are operating this business, the closed corporation, it means you register the business, the business must be registered. with the registrar of companies. You register the business with the registrar of companies. So what advantages are you going to enjoy? So the advantages of this type of a business are that you enjoy the characteristic of a company of unlimited liability. You have now limited liability. If the business has been registered as a closed corporation, you only lose what you have put in the company. They can't attach your personal property. In the event of death, you cannot lose your personal property. You can only lose what you have invested in that company. So then also, in terms of the paperwork, there is less legal formalities. So there are less formalities. So fewer formalities as compared to a company. So there are fewer formalities, fewer legal formalities. So it means you don't have quite a lot of obligations to follow, like if it's a company. For a company, there are a lot of rules that you need to be abiding to. You need to be paying the taxes. So if it's a closed corporation, there are less formalities. Of course, they are there, but they are less as compared to a company. Then another benefit is that we all take part in the running of the business. So managing, or we can say the responsibilities are shared. So it's just more like it's a partnership, but which has been registered, that it's now separate from the business. So it's now separate from the members. So we can have different people coming in, bringing their money. We can also have even one person running that business. So the disadvantage, which was common for partnerships and sole trader, was the unlimited liability. So if we want to override that disadvantage, we register as a closed corporation. So once it's a closed corporation, tikaita chikwereti munopedzerana necompany, not neni. So in the event that it's now a closed corporation, those that you are owing, they can take whatever they want, but from that corporation only. They cannot attach your personal property. Okay, so you can go and read that. Now, let's move on to the double entry system. So let's now introduce the double entry. So in accounting, we have what we call the double entry rule. So we have the double entry rule. So the double entry or dual entry says when transactions take place, they affect two books. For every transaction, there are two books which are affected. For every transaction, there are two books which are affected. So for every transaction, there are two books which are affected. So whenever we enter into a transaction, there are two books which are affected. There's the book of the receiver and the book that is given. So we need to make sure every transaction is recorded in two books. So every transaction must be recorded in two accounts. In one account, we debit. And in the other account, we credit. So every transaction, there are two books we should record. In one book, we debit. In the other, we credit. So those that have not done accounts before, if you see something like this is called a T account. So in our T account, this side is called the debit side. And this side, we have the credit side. We have the debit side, we have the credit side. We have the debit side and we have the credit side. So the first thing, before we know which one to put on the debit or which one to put on the credit, the first thing is to understand which two accounts are affected. So we've said for every transaction, there are two accounts which are affected. So let's start with that, identifying the two accounts affected. Okay, let's move on. So identifying the two accounts affected. So identifying the two accounts affected. So which are the two accounts affected? That's the first step. So we need to know in every transaction which two accounts are affected. But before we talk about identifying the two accounts affected, there are key terms to take note of. There are key terms that you need to know of. So if they say bought goods on credit, and they don't mention what is it that we bought. They just say we bought goods on credit. We record that account as purchases. If we bought goods on credit, those are called purchases. If they say bought goods on credit, the name of the account, we are going to record that is the purchases account. Sold goods on credit. If we sold goods on credit, the name of the account is the sales. If we sold goods on credit, we record that in sales account. Sold goods on credit, we record in the sales account. Sold goods on credit, we record in the sales account. Okay, besides the sold goods on credit, we can also have the owner introduced. The moment they use these terms, you need to know how you account for them. The owner introduced, or the owner or sole proprietor, the owner or sole proprietor, so if they say the owner or sole proprietor introduced, that is recorded as capital. Anything that the owner is introducing in the business, it increases the capital. So what the owner introduces in our books, we record that as capital. We can also be told that we took for personal use, took goods or cash for personal use. If we take something from the business so that we use for our personal use, those are called drawings. If you put your money in the business, it's capital. But if you take something out of the business, it's drawings. So if the owner took for personal use, that is regarded as drawings. Then, besides that, we can also have return the goods to us. So returning to us, those are returns inwards. If someone is to return goods to us, those are returns coming back to the business. We call them returns inwards. Return the goods to, if we returned to, those are returns outwards. We are returning to our suppliers. Returns to, it's returns outwards. So then lastly, if anything is done using a check, so if we pay using a check, we receive money in the form of a check, we record, we don't have an account called a check, but we use the bank account. Transaction done using a check. If we used a check, we record that as bank. If we pay using a check, we don't have an account called check account. We record it as bank. So these are some of the key rules to take note of. These are some of the key phrases to take note of. Then, we also have what we call the pairs. Again, that one I think we'll use it when determining which one is to debit and which one is to credit. So let's have an example. Identify the two accounts affected in the following. So identify the two accounts affected. Need to identify the two accounts affected. Okay, the first one. Paid rent of 200 using cash. B, bought goods on credit from T Wires of 400. Bought a motor vehicle by check bought a motor vehicle by check 3,000. And return the goods. Return the goods worth 230 to T Wires. Return the goods worth 240 to TYS. Then we can have the owner introduced. The owner introduced the cash 5,000 into the business. The owner introduced 5,000 into the business. Then lastly, you can say cash amounting to 340 was taken from the business for own use. Was taken from the business for own use. So was taken from the business for own use. So from these, we need now to determine the accounts to be affected. We need to determine the accounts to be affected. Say, Brian. So we need to determine. So we need to determine which two accounts are to be affected. So in this case, if we look at the first one, for A, paid rent 200 using cash. If we paid rent using cash, the two accounts affected in this case are, because we are paying rent using cash, so it means we have rent. So we have the rent that we are paying. What are you paying is rent. And the other account affected is, how did you pay the rent? I paid using cash. So there are two accounts affected. We have the rent account and the cash account. Bought goods on credit from TYS. I said bought goods on credit, that one is recorded as, if we bought goods on credit, those are purchases. So bought goods on credit, those are purchases. So the two accounts affected, the first one we have purchases. What about the other one? The other account is, if we bought on credit, we need to know who sold the goods to us. The other account is the name of the person who sold the goods. So we bought goods on credit from TYS. So the other account is TYS account. So the other account is TYS. So we have TYS account. Then we come to the C part. Bought a motor vehicle by check. So if they've stated what is it that we bought, then that's the first account. Like, we paid rent, so the account is rent. We bought a motor vehicle. So in this case, the account is motor vehicle. If it's clear what we bought, the account is the asset we bought. Then we bought this using a check. I said if a transaction is done using a check, we record that as bank. So if we bought the motor vehicle using a check, the other entry is to record bank. So the transactions that we do using a check, we record them as bank. Return the goods worth 232 TYS. So what you need to consider is, are we returning 2 or it's coming back to us? So if we are returning 2, it means those are returns outwards. Returns to, we said that's a returns outwards. So the other account is returns outwards. We are returning goods going out of the business. So we have returns outwards. And the other account, besides returns outwards, the other account is the person whom we are returning the goods to. So that's TYS. So we have returns outwards and TYS account. The owner introduced cash. So what the owner is introducing in the business is the capital. It increases the capital. So I mentioned if the owner introduced one of the accounts is the capital account. They are saying the owner introduced one of the accounts is the capital account. Then they introduced capital in the form of what? They introduced capital as cash. So if they introduced its capital, they introduced it as what? It's cash. If it was in the form of a check, we would say bank. If it was, they introduced a vehicle, it would be capital and the vehicle. So what they introduce is the capital. Cash amounting to 340 was taken for personal use. You take something from the business for personal use, those are your drawings. You take from the business for personal use, those are drawings. And what did we take? It's cash. So the other account is cash. So the first thing is to take note, which two accounts are affected? In the transaction, which two accounts are affected? After you have been able to identify the two accounts, the next step is to know which account is debited and which one is credited. Determining the account to be debited or credited. So after picking the two accounts affected, we need to determine which one is debited or credited. So in determining whether we should debit the account or credit the account, we normally use the Pearl's rule. So we use the Pearl's rule. To determine which account to debit or to credit. So we use the Pearls to determine which account should we debit or which one should we credit. So if you're using the Pearls, you break it in half. Pearls is P-E-A-R. So we take the first three. Then let's take the last three and put them this. So the first three on the Pearls, these are said to have a debit balance. The last three have a credit balance. Which are these? The P, it represents purchases. The E is the expenses. A is the assets. Then R is the revenue or sales. R is the revenue or sales. L is the liabilities. L is the liabilities. Then S is the share capital and reserves. So what does this mean? It means for all these first three, they have a debit balance. These, they have a credit balance. So if the account has a debit balance. It means that it increases on the debit side and reduce on the credit side. So if we want to increase purchases, we put them on the debit side because they have a debit balance. But if you want to reduce purchases, you do the opposite. So if it is a debit balance like purchases, if we want to increase purchases, if we buy more goods, that's increasing purchases, you put on the debit. So if you are dealing with a transaction with a debit balance, if you want to increase the purchases, they have a debit balance, you put them on the debit. Then if you want to increase an account with a credit balance, we credit the account and reduce it by debiting. So if an account also in a credit balance, if you want to increase the account, you credit. If you want to reduce the account, you debit. So that is for the debits and the credits. So let me maybe first of all, for the sake of those that are new to accounting. So the purchases, what are these? The purchases. When we talk about the purchases, these are goods we bought with the intention of reselling them. If we buy something to use it in the business, it's not purchases. So purchases, these are goods bought for resale. The purchases, these are goods bought with the intention of reselling. The purchases, they have been bought with the intention of reselling. Then we have expenses. Then we have expenses. The expenses, these are the regular payments that we're going to be making in the business. So the expenses, these are the regular payments which we make in the business in order to assist the operation. So those are expenses. So for the expenses, we can have a lot of expenses. I'll just list a few examples. Rent, rates, insurance, salaries and wages. You can have heating and lighting. All these are expenses. They are paid regularly by the business. So they might not say expense on the question, but the moment they talk about rent, you should know it's an expense. Like if we come to the points, the example, we paid, the first one, we paid rent. So it means this one is an expense, the rent. Then we have the assets. The assets, these are the resources. We have in the business that we are expecting to benefit from. So the assets, these are the resources we have that we're expecting to benefit from. The assets of the business, they can be assets that stay for a long time, which we call the fixed assets. And there are those assets that do not stay for a long time, which we call the current assets. So the assets can be fixed assets or current assets. So the assets can be fixed assets or they can be current assets. The fixed assets are those that stay in the business. Because you have to figure out, Trigger, that this is an asset. It has a debit balance. The fixed assets are those that stay in the business for more than a year. Those that stay in the business for more than a year, those are fixed assets. The assets that stay in the business for more than a year are fixed assets. Then we have the assets that stay in the business for less than a year. Those are current assets. These stay in the business for a period of less than a year. They stay in the business for a period of less than a year. Let me list the examples. Some common examples of fixed assets. We have premises, motor vehicles, buildings, we have plant and machinery, or furniture. So these are fixed assets. They stay in the business for a long time. Besides the fixed assets, we have the current assets. So for the current assets, we have inventory or stock. So we have inventory, receivables, or we can say debtors. We have bank, we have cash. All these are assets. If payment is made using a bank, it's an asset. Cash is an asset. If we talk about receivables, they are assets. So why do you need to know this? Because when you're now saying paid rent using cash, you need to know that cash is an asset. And if you pay using an asset, you are reducing an asset. So if you are reducing an asset, because the asset is a debit balance, you reduce it on the credits. So if an asset is a debit balance and you have to reduce it, you reduce on the credits. So for today, we are going to end here. So for today, we are going to end here. Then we'll resume from the double entry. So I want you to go through what we've been discussing. I'll send the slide. Try to go through it. Try to go through the module as well and the other references. Then the next lesson, we'll talk about now determining which one is to be debited and which one is to be credited, and maybe coming up with the T accounts. Then on our timetable, we have business law 1, which is supposed to start at 12:30. But for that one, today I will send a recording. So for business law 1, I will send a recording because my device now is running out of power because of where I am. So I'll send a recording because where I am, once I disconnect, it can end up I might not be able to finish the session. So I'll record, then send the recording. So I think for today, let's end here. Then thank you so much for